Hi guys, Marissa Schultz here, author of The Rise High Investor. Thanks for tuning in. As I do every week, today I'm bringing you a short video to help you with your property investment goals. I hope you enjoy it. Today we will be talking about the 3 things banks are looking for when they assess your loan application. This is a really important topic because as a property investor, having access to the finance you need is absolutely critical if you want to grow your portfolio in a steady way and achieve your property investment goals. So it's really important that you understand what the banks are looking for, that you put your best foot forward and you ensure that you protect and manage your borrowing capacity moving forward so that you can achieve your property investment goals. So let's look at the 3 things the banks look for. Number 1, they look for your ability to service the loan, servicing capacity. So basically what that means is they're really looking at what's your income, what are your expenses, and how are you actually going to be able to afford to fund this new loan that you're applying for. Now let's just put let me give you a few tips here. When they look at your income, they won't necessarily take 100% of your income. So for example, the rental income that you receive from your existing properties, they'll be discounted back. So the bank will allow a buffer in there. When they look at your expenses, they will sometimes add a buffer to your expenses. So for example, if you've got loans with other lenders or if you've already got existing mortgages, instead of looking at what they're currently costing you at today's interest rates, they may add a 2% buffer on that and they may actually cost it out as if the expenses are higher than what they are. So really what they're looking at is they're actually not looking at what is your current situation in terms of your actual income and your actual expenses. They're looking at a worst case scenario. If your income was a little bit lower, if your expenses were a little bit higher, would you still be able to afford this loan? They also now are getting really hot and heavy on living expenses. So as a new applicant, you have to declare all of your living expenses and break it down by category. So having a really good grip on what your living expenses are is always really useful if you're going to go to apply for a new loan. We're also finding that banks are actually testing these living expenses. So instead of just taking your word for what you've declared, they may be looking at your credit card statements or your bank statements to actually see whether what you've declared is realistic. So it's a really good reminder here to actually review your living expenses, understand what they are, and it's a good opportunity for you to see if there's any wiggle room that you can actually save some money there too to bring those living expenses down, because that will ultimately help you in terms of improving your servicing capacity for future loan applications. So first thing, servicing capacity. I think we've covered that. Let's move on to number 2. Number 2 is your equity or your deposit. So where are you going to fund the difference between what the bank's lending you and what the property is going to be costing you to buy, plus all of your purchase costs like your stamp duty, your conveyancer fees, all of that sort of stuff. So are you going to pay, are you going to meet the funds to complete through a cash deposit that you have saved, or do you have equity in another property that you'll be releasing to fund the purchase? This is what the bank's looking for to ensure that you can actually complete the purchase at settlement. So that's equity and deposit. Finally, and more importantly than a lot of people think, it's quite significant these days, is your credit history and your credit score. So we will soon see positive credit scoring being introduced in Australia, and that's already started. So basically what that means is that the banks actually know a lot about what's going on in our life in terms of how we manage our credit facilities and all the good, the bad and the ugly. So it's really important that you pay your bills on time, make sure that you make your loan repayments on time with and don't miss the due dates, and make sure that you're managing your debt facilities really effectively. Take control of this area of your life, because it will start to become a problem if you're not paying your telephone bills and your electricity bills on time. So make sure that you're managing your income and expenses really carefully. So they're the 3 things: servicing capacity, equity deposit, and your credit history. Protect those 3 things and you will be fine. I hope you enjoyed today. That's all I've got time for. Thanks for tuning in. As a thank you for watching, you can jump on the website risehighinvestor.com.au and you can actually get a 50% discount off of the book if you enter in the code video2018. So hop on there now and grab a copy, and if you would like to contact me, you can email me at propertyinvestor@risehigh.com.au. I always love hearing from you with your comments and questions. Thank you so much and have a great week. Bye.